But in terms of the corporate earnings front, earnings coming through from the United States, we have the Mag 7, 4 of them reporting this week. And some of the earnings were a little bit weaker than expected, which was to blame why we saw a bit of a pullback in the markets, coming off the record highs for both the NASDAQ and the S&P. What are you looking out for in terms of the corporate health of all these companies?
Look, markets are effectively extremely stretched. We see it's a bit specific to this time of the year as well. Liquidities are much lower, and what we see is a bit less of institutional volumes and much more retail volumes that keep markets high. Now, what we are really focusing on at the moment is we look at margins, how margins continue to evolve for these companies. I think that's really key, and these margins are extremely high at the moment. We are reaching historical peaks. We also look at capex. Capex is extremely good. We had Google reporting last week with a massive increase in capex. Some people are Google is all out in AI. They are not. So, which is also comforting. So they have a lot of room to invest, but capex is extremely important, particularly with regards to the AI industry, because it trickles down to a lot of other sectors. Typically, we've been investing a lot in Europe in companies that provide, for example, electric supplies to what is needed across the entire supply chain of the AI industry, typically for data centers, for hyperscalers. So capex is one of the aspects that we look closely with regards to the earnings, particularly for AI exposed major companies.
Now, earlier we were discussing and you were talking about not buying into the market. So can you explain to us a little bit, why aren't you buying? What are you looking at and how are you investing?
Yeah, so I think everyone knows that we are at all-time highs. We are also, in terms of multiples, at very peak levels. I mean, if we look at the median price earnings on the S&P 500, we are currently trading at 22 and a half, while mean is probably around 19 and median value is around 16. So we don't want to buy on the highest levels. And we also look at the profitability of companies. In order to maintain the current prices, they really need to deliver going forward. We see EPS growth slowing down gradually. So growth is slowing down. However, the earnings season is really strong. So we continue to observe this closely. We would prefer to have a bit of a pullback in the market in order to buy more. Sounds easy to say. A lot of investors are waiting for a pullback that is not coming. However, it would be a bit healthy. Maybe it's also seasonal. We are not actively protecting portfolios because we're not over allocated to the markets at the moment. However, for investors that had a good performance, it was a tremendous rebound since April. I was looking at the beginning of the week. If you would buy an out of the money put on the S&P 500, let's say 3% out of the money for the September term, it would cost you roughly 1%. I think it's money that would be potentially wisely spent in order to digest a little bit this period with a lot of moving pieces that we're having, earnings, Fed speak, and tariff talks.